A very good afternoon to you all, friends. I am Sanjeev Singhal, Central Council Member and Chairman, Auditing and Assurance Standard Board and Chairman, Sustainability Reporting Standard Board of ICAI. I, along with my Vice Chairman, C. Vishal Doshi ji, welcome you to the 65th program of the AASB for this council year. Friends, it's been our endeavor to take the learning of the auditing standard to the doorstep of every member. And this program is one more attempt to do so. So far, we have covered all the auditing standards. We have also covered all the elements of the financial statement which pertains to audit. We have covered CARO, and now we are covering some specific aspects. Today's topic is practical insights into audit of non-corporate entities. So those companies which are not corporate entities. So some practical aspects while doing the audit of those, because these days audit of those entities are also going on. This year, AASB has taken many steps, including guidance to our auditors on the matters which they may come across in the audit of corporate as well as non-corporate entities. We have constituted an expert panel in which 50 experts are there who answer the queries of our member if these queries pertain to the auditing matters. And friends, I'm very happy to share that today C.A. Chinnaswamy Ganeshan ji is the guest speaker who has very vast experience, very vast knowledge on IFRS, Ind AS as well as auditing standards. I had the opportunity of meeting him in person several times, and he has been associated with the institute in many committees, and he's also been associated with many chambers of commerce and also given training at RBI, CNAG and other banks. Thank you, Ganeshan, and thank you for being there. And friends, today's keynote speaker is my elder brother in the council, a person who I admire, C.A. Charan Joshi Nandaji. Nandaji is the chairman of Internal Audit Standards Board of ICAI, and he is presently a Central Council member in this 25th Council, and he has been a Central Council member for several terms. Apart from being the chairman of the Internal Audit Standard Board, is also the chairman of a very important board, yet another very important board, which we call as DAB, Digital Accounting and Assurance Board. He is also a vice chairman of the Banking, Financial Services and Insurance Committee. He has been a member of the Quality Review Board set up by the Government of India, and he has been the chairman of the Committee on Internal Audit of the ICI and also the chairman of Committee for Member in Industry. He was also the chairman of the Women Empowerment Committee of the ICI and has been a vice chairman in many committees of the institute. He has been a member of the SEBI Advisory Committee on the Primary Market as well as the Mutual Fund, and has also represented ICI in Skoda. He was the convener of the expert group constituted by the Ministry of Corporate Affairs, Government of India on Investor Protection. He has been a member of the SAFA Committee of Professional Accountants in Business. He has also been a member of the NIRC for 2 terms and has been a chairman of NIRC in 2002-2003. Thank you very much, Nandaji. You have been very kind to me always. Thank you for your kind presence, and I would request for your keynote address, and then it will be followed by our guest speaker for the day, C.A. Chinnaswamy Ganeshan. Over to you, sir.
Thanks a lot, Sanjeev, for your kind words. In fact, I am always influenced by your adaptability to work in differential situations and create value. I have always admired that, and that is why on every beck and call I am there. Being the chairman of AASB and Sustainability Board, you have always tried to scale newer heights for the profession so that things are put at the right esteem. I am equally impressed by C.A. Chinmay Ganesan. In fact, I was a CP chairman last year, CP vice chairman last year, and his contribution was immense. I am noticing that Mr. Ganesan is always there whenever the question of institute rises. And largely, AASB is doing so many programs to educate our membership at large, which is very, very important. Today's topic, practical insights into audit of non-corporate entities, is really something which would add value to the audit initiatives of all small and medium practitioners. I take this opportunity to welcome all participants to this webinar organized by Auditing and Assurance Standard Board of ICAI. You are all aware that over the period of time, extent and size of economic and financial activities of non-corporate entities have grown significantly. Further, economic development has led to increase in number of non-corporate entities in the country, and therefore their audit again becomes a pertinent issue, how they are guarded, how regulatory framework is put in such a way that all sail in the right direction. Audit of non-corporate entities is required to be conducted in accordance with the standards on auditing issued by ICI and monitored by AASB, which the committee Mr. Singhal is chairing. Now, I want to tell you one very important thing, that no specific exemption has been given to given in standards on auditing for audit of non-corporate entities. So whatever is to be done has to be done as per the normal audit procedures, and therefore it is very, very important that the audit of non-corporate entities is taken very, very seriously. Now, coming on to a different ball game. You are aware that the International Auditing and Auditing Standard Board, IAASB of IFAC, has undertaken a specific project to develop separate auditing standards for audits of less complex entities. India had tried to move twice in one meeting in Paris. Again, we had tried to emphasize on this fact, then we again did it. But now with IAAS coming into it, it becomes imperative for the institute to see for the purpose of homogeneity, so that all across the board, proper homogeneous auditing practices are prevalent. And therefore, we are now given the baton to IAASB. The ICI, your mother body, has been watching this development at IAASB level. ICI will also undertake this project once the above mentioned separate standard is issued by IAASB. The basic purpose is to see that whatever standard is issued by IAASB is tuned by local customs and usages and are brought for the benefit of small and medium practitioners. Ladies and gentlemen, I want to tell you one thing very candidly, that institute is now on a technological upfront. Your institute, you're all aware that we have so many constituent members of IFAC, but your institute was the first to come out with guidance on remote audit way back on 30th March 2020, when COVID had barely started. Your institute, I am chair the DAB. DAB has come with 23 forensic accounting standards, which is first in the world. Your institute is totally working towards creating new benchmarks so that the members can be effectively educated, and their quality of audit, their quality of reporting is something which becomes predominantly important, not only for the clients or stakeholders, but for the regulators and government also. So, ladies and gentlemen, I give my best wishes to this great program. I see a lot of hopes in the verdict and the deliberations by CA Chinmay Ganesan, who is a man of great order, and under the chairmanship of Sanjeev Singhal, I am very keen that we shall be able to scale near heights in terms of giving proper guidance to small and medium practitioners for audit of non-corporate entities. So over to Sanjeev Singhal so that Mr. Ganesan could be called for his presentation. Thank you so much, sir.
Thank you very much, sir. Thank you, Nandaji. And with this, I now request C.A. Chinnaswamy Ganeshan to kindly start his deliberation on the topic of practical insights into the audit of non-corporate entities. Over to you, Ganesh.
Thank you so much, the chairman of WASP, as well as the co-chair, and both of you are good friends and also giving me a lot of areas to work closely for the institute. Thank you so much for continuing to do that. And in respect of this particular topic, when it is coming from auditing and assurance standard, as rightly set the context by the chairman and co-chair, what I have seen is that the number of entities which are served by small and medium practitioners are increasing day by day, because most of the entities are in non-corporate sector, and the way in which the attest function is being performed, maybe for the purposes of the taxation, or maybe for the purposes of giving the attested financial statement for bankers and financial institution, or maybe for any other purposes, when this type of work is being performed by the professionals, normally we have a feeling that this standards on auditing or the audit, when we are talking about for a non-corporate entities, is not taken with such a seriousness as we are doing an audit of a company. Maybe because we believe that there is no law which is regulating the audit of non-corporate entities. But what we have seen in many circumstances is when we have given an attest function, or when we have given an audit opinion in respect of the financial statement of a non-corporate entity, sometimes we have been dragged on in litigations or disciplinary proceedings or penal actions by the regulators, because some of the financial statements might have been relied by the bankers and other stakeholders. So in such a scenario, the first and foremost question which is coming to us is whether audit per se is mandatory for a non-corporate entity. There is no law which specifically says that all the non-corporate entities should be audited. But when it comes under the purview of a particular law or regulation, where it requires an attest function to be done by a chartered accountant in practice, the audit of non-corporate entities becomes mandatory under that particular statute or law or the provision of maybe an act or a regulation. So in such circumstances, the professionals are necessarily has to follow the standards on auditing in carrying out the audit function. If it is not being adhered to, there could be a possibility of the final outcome or the audit opinion may not be properly supported by sufficient appropriate audit evidence, or maybe the procedure which has been performed is not adequate in accordance with the standards on auditing, or maybe the conclusion which has been drawn up based on the work performed is not in line with the actual work performed in respect of the audit of non-corporate entities. And accordingly, I believe that equally it is a responsibility for the chartered accountants, whether they are doing an audit of a company or doing an audit of a listed company. When they are doing an audit of a non-corporate entities, naturally the requirement is to look at what is the prescription or guidance or application guidance which has been given by the various standards on auditing. Before I start, I should also wanted to put forth, like the co-chairman has already mentioned, that a lot of guidance or not a lot of initiatives are being taken by the Institute of Chartered Accountants of India. And one of such initiatives taken by the Auditing and Assurance Standard Board in 2020 to revise the guidance note on, or maybe I can use the exact name, Practitioner's Guide for Small Audits. So that literature or the guidance note, I wish to say, or maybe I can even go to the extent of saying, I urge everyone to look at that guidance note, which gives an audit of a non-corporate entities, what are all the documentation which you have to maintain, etc., is what we are supposed to look at. Okay. So having said that, there is a proactive measure which has been taken by the board of ICA, WASB of ICA. Let us look at what we are going to look at in this particular discussion. First of all, as we have started discussing, whether audit is really mandated for non-corporate entities in all circumstances is what we have to look at. And secondly, whether the standards on auditing which has been issued, because we have two sets of standards on auditing. One is notified under the Companies Act under Section 143, subsection 10. But again, as of now, that is exactly the standards which has been issued by the Institute of Chartered Accountants of India under the guidance of WASP. Plus, any other technical guidance which has been issued by WASP in carrying out the audit activity by a practitioner or maybe the practicing unit, as the case may be. What type of applicability which we are having, and what are all the focus standards or maybe important standards which we have to consider, because it may be difficult for a non-corporate entity to give all the information which is required, maybe an exhaustive information, basic information may be available. With the basic information, how to effectively conclude an audit, conduct an audit and conclude on the audit opinion based on the standards and auditing is what we are trying to look at in this particular session. And thirdly, some of the areas which are very, very important for a non-corporate entity, we will try to look at what is the practical insights which has been given and what should be the audit procedure which we will perform. And we will also look at some of the key auditing standards more relevant for a non-corporate entity. So even though there is a basis in which it has been classified under the accounting standard as non-company entities, very commonly we are using non-corporate entities. That's the reason why I am using the word non-corporate entities for the benefit of the members who are attending this particular session. You have two things which you can actually do. Your questions can be posted in the Q&A box or whatever text box, so that at the end of the session, if any questions which I have not dealt with during the course of the presentation, I will answer that in the last 15 minutes of our discussion. And of course, at the end of the session, I will also share my contact details. And of course, the presentation has already been shared with the WASP, but very late. They will also share with all the participants, which you can download and use it for your future references. So the need for this discussion is also says that when we are talking about audit is really mandatory for a non-corporate entity, or it is only for a corporate company. When we are looking at the corporate audit vis-a-vis the non-corporate audit, normally we tend to make a differentiation by saying non-corporate entities are smaller in size, and accordingly there should be a relaxation in even the work which we are performing in respect of audit. And when we are doing an address function to non-corporate entities, we will not to be required to put forth so much of effort, because when we are looking at the fee which could be charged for a particular engagement and the number of hours which we will be spending on that particular assignment, whether it will be commensurate with the efforts which has been put in, that is normally a question which is coming in. But the answer which we are having here is size should not influence any audit engagement. It may be bigger audit, or it may be complex audit, it may be a smaller audit, it may be a simple audit done for the purposes of tax audit by a tax auditor. But in all circumstances, what we are saying is audit is an audit anyway. So you cannot differentiate. A bigger audit is something different and smaller audit is something different, and accordingly the smaller entities, non-corporate entities, should be totally away from the purview of audit. Only thing which we wanted to put forth on this particular situation is that the complexity involved in a listed company audit, or complexity involved in a company audit, or maybe complexity involved in a even smaller company audit may not be same when we are talking about a non-corporate entities. For the simple reason, the laws and regulations relating to the non-corporate entities is not having any relevance to the company's audit. So that's the biggest relief. So the compliance with the company's audit per se, we will not look into that in detail. But at the same time, when we are looking at the financial statement and how it should be presented, whether it should be complied with the accounting standards, etc., we have very clear distinction that in respect of listed companies, we will go for Ind AS. In respect of other than Ind AS companies, we will go with the standards which has been notified under Section 133 of the Companies Act. And in respect of the non-corporate entities, we will go with the 4 levels of classification given by the Accounting Standard Board. But since it is relating to audit, what I am trying to restrict myself for the next 1.5 hours or so is how to carry out the audit of a non-corporate entities, maybe in a practical manner, more effective manner and efficient manner, so that the risk relating to an audit, because of the size, we cannot ignore it. That risk relating to that audit is fully covered, but at the same time, we are effectively doing the timing, our cost, etc., how we can effectively do that particular audit is we are to do, whether it's a small audit or big audit, the standards on auditing remaining the same. Maybe the complexity of the transaction which we are auditing or the complexity of the procedure which we will apply could be reduced. So that is one thing which we have to look at. The second is, even though we are saying that the audit of non-corporate entities is not mandatory under a particular law, but various situations it may be mandatory. As I have started with saying, when the particular non-corporate entity wanted to raise funds or it is having a limit with the bankers, the Reserve Bank of India has made that even for a non-corporate entity, specific audit report has to be obtained by the borrower and he has to submit with the bankers. Bankers has to review that particular item. You may remember that when you are doing for the bank branch audit, in LFAR, there is a specific clause which is asking, or you are talking about a company, or you are talking about a company, or you are talking about a non-corporate entity. If it is a non-corporate entities, the borrower, whether he has got the audit side or special audit which has been required to be done by the RBI on the financial statement for the fair presentation, whether it has been received. That is one of the requirement. And majority of the clients who are coming to us from the non-corporate sector may be having a funding done by bankers and financial institutions, and this requirement may make it mandatory. The second is, all the non-corporate entities may also have the possibility of falling under various categories. For example, a non-corporate entity may be a partnership firm, it may be a proprietary firm, it may be carrying on a non-profit, it may be carrying on the business of non-profit organization. All this could be possible. So the structure may not be very relevant, but the way in which they are carrying out the work is relevant. For example, when we are saying that they are supposed to be audited for tax audit purposes, for filing with the income tax department, naturally, it is an audit which you are giving. If you see even the Form 3CB, which you are giving that because it is not audited under any other law, you are doing the audit, you are giving Form 3CB for the purposes of tax audit. If you read the paragraphs given in that, you are able to link it with the format of the audit report, which has been given in Standards on Auditing 700. It talks about identification of the financial statement, the client, the year, and then what is your opinion and what is your responsibility? Do you have any reservation or remarks which you wanted to give? And finally, when you are signing in the same manner like what you are signing for any other audit report. You are signing with a firm name, firm registration number, the partner specifically who is signing it, or the proprietor, and what is his designation, what is his membership number, what is the place of signature, and what is the UDIN number. So everything comes as a requirement when we are doing even a tax audit, Form 3CB. And Form 3CB is talking about whether the balance sheet is fairly presented, whether the profit has been fairly presented. So like that, they are going in the same level of a financial statement audit requirement. So that is one thing which we can say that is also one of the requirements. If this NCE, non-corporate entity, is carrying on a charitable activity or a not-for-profit activity, then there may be requirement for them to get the accounts audited for many purposes. For example, even for raising donations from other corporates, they may look for an audited financial statement of that particular entity. Even if a particular entity wanted to get itself registered under CSR requirements so that they can do it, they may require an audited financial statement under that particular situation. Even FCRA regulations require, when somebody is giving the money for a project, they may require an audit to be conducted on the end use of the funds and giving the opinion on that particular project. So these are all the cases where we will have a lot of audit requirement mandatory for the non-corporate entities depending upon the particular situation. So accordingly, there should be a regulation, there should be a method, there should be a guidance which has to be considered. And as rightly pointed out by the chairman, even non-corporate entities transactions are becoming complex. I've seen cases that a company, an entity which is a partnership firm, is carrying on business equivalent to the size of more than a medium-sized company. And they have all the complexities, including forward contract, mark-to-market adjustments, etc. Their transactions are also becoming complex. In this scenario, there should be a proper way in which the audit of a non-corporate entity should be done by the practicing unit. And of course, the complete guidance which has been provided by the standards on auditing, if I have implemented as part of my audit of a non-corporate entities, the future litigation, even if it happens or somebody is initiating a proceedings against the practicing unit, you will be able to support your conclusion by saying that you have carried out the entire audit in accordance with the standards on auditing. So compliance with the accounting standard is a different ball game, but doing an audit for the financial statement to be submitted for various regulations or various situations, how to carry out that audit is more critical. So only if you are planning, executing, and concluding a particular audit, you will be able to give your opinion, or you can sign a particular audit report, or maybe even a tax audit report. So what we are looking for in this discussion is how we can comply with the requirements of the standards on auditing and how efficiently we can carry out this particular audit. I was just trying to look at the various services which we are providing to a non-corporate entities. It may be an audit, it may be a review, and it may be an agreed upon procedure, or it may be simple compilation of the data into a presentable format or readable format. In all these circumstances, we are looking for what type of guidance or what type of reports which we are actually giving. For example, when we are talking about compilation, we are not giving any assurance. When we are giving agreed upon procedure, we are not giving any assurance. When we are giving a report on limited review, in case if somebody is saying no need for carrying out a detailed audit, give me only a limited review. In that case, there could be a moderate assurance. But what I have seen in my particular situation is we are normally carrying out a lot of audit activities depending upon the way in which the business is being carried out, depending upon what is the requirement of the various laws and regulations under which a non-corporate entity is operating, we are doing an attest function. So we are actually giving a high assurance. But the only thing is we are not giving an absolute assurance. When I say high assurance or a reasonable assurance, but not an absolute assurance, necessarily I have to carry out all my audit function in a proper manner, right? When I am carrying out the audit function in a proper manner, then only I will be able to give positive assurance on the various assertions or various promises, and also look at the specific reporting requirement. So we are trying to look at this particular area as our discussion, and what are all the various things which we are supposed to look and carry out in respect of this particular audit of a non-corporate entity. I made a simplified audit approach to start with Because when you are carrying out a very detailed audit, it may be unwarranted. When you are carrying out very tedious audit procedure, very extensive audit procedure, it may not be commensurate with the requirement. So the effective way or the efficient way in which we can carry out the attest function is a simple process of looking at how the management is deriving the comfort. The biggest plus point compared to a corporate audit with a non-corporate audit is majority of the business is being run by the owners of the entity itself. Maybe the proprietor will be running the business, or the partners will be conducting the entire activity, or the particular trustee will be regularly involved in that particular activity. So that means when the owners are involved in doing the day-to-day activity of a business, they will be definitely trying to get comfort that the company or their entity is performing in a proper manner or profitable manner, and there is no lapses in compliance with the laws and regulations. They are not losing money, and they are also complying with the various laws and regulations applicable to them. So when this particular thing is possible because of the close way in which the owners of the entity are carrying on that function, what we have actually seen in our scenario is that understanding the client's business, understanding the risk involved, understanding the control processes relating to an audit becomes very simple when it comes to these entities, because the understanding of the business, the owners will have much more than what a corporate setup will be having. Because in a corporate setup, we have professionals who have been assigned a departmentalized activity. They may not be having the complete understanding of the business. But if you go and ask a particular business owner who is in non-corporate sector, you'll know each and every aspect of a particular activity. The second, in fact, I still remember that when I was talking about the profitability of a particular partnership firm, when we were doing a tax audit, we were finding that the net profit has increased significantly compared to the previous period. But my understanding is that this business may not have more than a particular percentage of net profit on a normal situation. And is there any reason why they are making such a profit? So when we are trying to analyze, the first thing which our team was trying to do is that they were trying to analyze each and every line item of the balance sheet, each and every line item of the profit and loss account, trying to do some exercise on the economic environment in which that particular entity is operating. So instead of that, what I have simply made is made a phone call to the owner or a partner, one of the partner of the business, and asked this question. He immediately responded saying that the maximum possible percentage of profit in my organization could be ranging between 8 to 10%. If anything more than 10% is something wrong in the accounts, so I will look at that particular aspect. When we went back to him, when the percentage was more than the expected levels, when we went to him, within no time, he has identified that these are the areas where problems could be there, because they know the business better than anybody who is running that business, because he is involved. His stake is actually involved. And accordingly, he will look into the business and run the business in a manner in which will be efficient. And he will also know what are all the risks associated with that particular business. And he will also try to understand one problem which we normally have with the non-corporate entities is their internal control processes or internal control system may not be as robust as a corporate entity. But at the same time, I have seen that the internal control system is not just, it should be very robust, or it should be arresting each and every, it should not, whether it should be extensive for every case. No, even the key controls relating to a business process has been taken care by the management, and that will ensure that the company is not losing. So similarly, if the key controls relating to a particular process has been properly monitored by the management, even for a non-corporate entities, we will not have an issue. That is exactly what we are trying to see, is that understanding the business, understanding the risk, understanding the control processes, how the management has relied on those items. And we build on that management reliance and see, this is the way, when somebody is saying that my profit cannot be 12%, it can be only between 8 to 9%, then what is the reason why we are getting a 3% excess? Management is having its own method of reviewing the accounts because he is running the business, how they are relying on the various aspects. And from that, we build based on our previous knowledge of the client, our experience with the particular business in which the client is operating. That should be the basis for our activity relating to audit of a non-corporate entity. So it's a simple process in which you can start. When we understood the business risk and control processes, we should also evaluate whether they are really doing that activity on a routine basis, they are updating it, and whether they are working on any operational targets, whether the company or the corporate company, when we can benchmark that with the corporate company, whether the entity can equally be benchmarked and see whether it's performing properly. So the business risk, the business knowledge, the control processes is being evaluated as the next one. But what I have seen is that understanding the business and risk evaluation can be possible in respect of majority of the non-corporate entities, but control evaluation, majority of the cases it fails. So the reason is the entire work is being performed in an environment controlled by the owners of the entity. So management override of controls will normally be there, or maybe there will be a lethargy in which they will believe that since I am carrying out each day-to-day activity, there is no need for setting up a separate control environment. The another reason could be, for example, if I am talking about a maker-checker requirement for a control, it may not be possible for a proprietary unit or a small partnership unit to have too many people to take care of the control environment. Instead, they will say, I can control the transactions, I can validate the transaction, I can evaluate the transactions for its correctness or not. And accordingly, when the control environment or control processes evaluation fails, my suggestion is we will be forced to go for a substantive procedures. Majority of the cases, 90 to 95% of the cases, we can complete the audit only by means of substantive procedure, not based on control reliance. That is one small drawback which we are having. And of course, we know how to carry out that substantive procedures. How the control, when the control fails, how I can get the comfort on the substantive procedure? Very simple concept. Component wise or the financial statement line item wise, what type of risk which you have assessed or understood in the first scenario, and how you wanted to check that the risk has been mitigated by means of your audit procedure, and it has been reduced to the lowest level or acceptably lowest level is what we are supposed to look at, right? So that is a way in which you are looking for your next level of activity. And one thing which I have seen, even in tax audit cases for non-corporate entities, we are trying to do 100% of the transaction as an audit process. Not at all required. When you are relying on the standards on auditing, materiality derives the way in which the nature, timing, and extent of your audit procedure to be performed. But we are simply ignoring the concept of materiality. There is a standards on auditing on materiality, SA 320, if I'm not wrong, which talks about materiality, based on which you can fix up the materiality, and anything less than the trivial materiality, you can simply say that these balances are not material and ignored on the concept of materiality. Concentrate on the other areas. Even when you have fixed a materiality, you can focus on significant account balances by identifying based on the risk involved in that particular business. For example, if I am talking about majority of the non-corporate entities, the significant risk may be it's connected with the sales process, or maybe relating to property, plant and equipment process, or maybe on the inventory process, or maybe on cash and bank balances process, or maybe relating to employee cost or payroll cost, right? These areas are what may be important for you. And of course, you have to also look at, or you are preparing the financial statement, or you are auditing the entity is preparing the financial statement, and you are auditing for a particular laws and regulations. What are all the requirement of a particular law, maybe taxation, etc., etc., right? That is the way in which you can do. And another thing which I have normally seen as the biggest help for a non-corporate entity is what we call as an analytical review. What do you mean by analytical review? You aware of this? We are simply comparing what is the current year number with the previous year number, and what is the variation, whether the variation which is happening between these two numbers is supported by a logical relationship with another component. For example, if I'm saying my debtors has increased by 20% and 30%, immediate relationship I look for is whether my sales has increased by 25 to 30% compared to the previous period. When the sales have come down, but my debtors have increased, there is always an issue relating to whether the entity has a risk of non-collecting its receivables at a proper within the time, or maybe on a proper follow-up process. When we say that, it may even end up with having the cash flow mechanism is completely affected, and in the process, the company or the entity may get into a scenario of having a going concern issue also. So this analytical review document, you can do it before you commence the audit, based on which you can identify what are all the key areas where you wanted to focus. And also, when you are doing certain activity, you can even do the analytical review as the audit procedure. For example, if I wanted to validate rent payment, whether all the rent has been properly accounted for. In a non-corporate entity, maybe 2 or 3 lease agreements could be there. What is the per month rent multiplied by 12? Add up all the items. It is your expected number. You are setting an expectation without even looking at the financial statement of the entity. And then you may also fix up some sort of deviation from that. When I'm saying deviation, I have assumed that all the 12 months it is occupied. There could be a possibility that it might have been occupied only for part of the period, or maybe the rent which has been previously paid, they have negotiated and reduced, or there is an escalation of rent. There could be a possibility of all these things which may happen. And I might have given up certain leases during the particular period. So accordingly, when I have fixed expectation, I also fix what level it can be deviated. That deviation may be 5 to 10% if I am fixing it. So if I have calculated the numbers expected is around, say, maybe because it's a non-corporate entity, I will take a smaller number. I'm expecting somewhere around 3.6 lakhs per annum. And I fix a deviation of 10%. So 36,000 rupees, even if it goes up or goes down, I will accept that this entry which has been passed by the entity has been correctly accounted for. You may ask, sir, how you are doing only averaging activity, whether it is correct to conclude on that basis. Please refer to the analytical review procedures which has been given in the standards on auditing, which gives an elaborate guidance. The only trick is, have you set up an independent expectation before you started the work? Have you fixed the proper deviation from that? And if there is a difference which is coming beyond the deviation, have you evaluated the deviation and that ascertain the reasons for that? And the reasons, if it is not correct, or you are going to pass an audit adjustment, audit JV. That's the way in which when you are doing, you'll find that analytical review can help in majority of the cases how you can do it. The next one is your substantive procedures. when you are doing a substantive procedures, you can do a lot of audit activity based on the data which is available with the client. For example, I have seen that majority of the audit client is using a particular software, Tally. The Tally provides an audit function also. A lot of exceptions can be generated through Tally, and that can be further evaluated by the auditor. So you can carry out the substantive procedure for a particular items and deep dive where it is required. So with that, you can actually make your audit opinion or come to a reasonable conclusion based on which you can actually able to do your work in a much efficient manner. So that's what I'm trying to say. From scope to completion, you can have this simplified approach for a non-corporate entity. If I complicate it further, that will be applicable to a corporate entity or a bigger complex environment. Only thing is the way of understanding my client's business, the risk involved will go in depth. The evaluation of control will go in depth. So here we are only doing a simplified process, and the simplified process will give me the comfort. So what is relevant is understand, evaluate, validate your expectation, and based on which communicate by means of your audit report. Just have this understand, evaluate, validate, communicate. You can do a very proper audit of a non-corporate entity. Following this simplified audit approach, if I have to move from a very small non-corporate entity to a medium size, or maybe the complex transactions are also there in a non-corporate entity, I will suggest you to think about, can you go for a top-down risk-based approach? Risk-based audit, internal audit is also possible, risk-based internal audit. Similarly, what is the risk associated with a particular business when we have assessed it? And what are all the key risks relating to that? If, for example, if your client in a non-corporate entity is in a retail business, the normal risk which we will talk about is the sales process as the key risk. And we will also talk about the inventory risk, because the taste of the customer will change, and because of that, inventory obsolescence could be possible, and there could be possibility of cash embezzlement, which may happen because you do a lot of transactions through cash in a retail business. But nowadays, majority of the people are going for digital payment, and accordingly, that is also getting arrested to some extent, right? So what are all the top risks involved in that particular non-corporate entity? And for that, which is the topmost priority for you, which may result in a material misstatement? And what is the key business driver? When we have identified, what will be the impact of that particular risk or the key business driver not being working? What would be the situation, or what could be the likelihood of risk of material misstatement? ROM is nothing but risk of material misstatement, right? So don't think that I am teaching auditing paper to you, but unfortunately, we are going to our schools again because of the various complexity which we are seeing from the regulator's side, right? The risk of material misstatement, which may result in a material misstatement. Don't think that you can be 100% correct when you are doing an audit. So you may think that it's a smaller company, so smaller entity, so I will be able to validate everything. But also see the other side of the story. What is the cost versus benefit, right? When I say by using the standards on auditing, I can complete an audit in 100 hours. But my traditional audit approach says that I will be requiring 300 hours. The 200 hours are spent unnecessarily. The cost of the 200 hours for your firm, whether it is being paid by the client, and for the client, whether it is adds any value by spending the 200 hours. just because he wanted to go in a traditional manner, which is not required to be done. It's a excessive audit, which is not required. Whereas you can do an efficient audit, effective audit by doing in accordance with the standards on auditing when you are looking at what is the risk of material misstatement, etc. And based on this, the risk can be associated at the various assertion level. This is also a term which is used by the standards on auditing. But when I am saying the explanation for this, you'll say, oh, this is what you are talking about. And even the client will also understand when I am saying, sir, you have to give me complete comfort on the assertions level. The non-corporate entity will definitely run away. But if you are saying that, sir, the risk which I have identified in your business is relating to inventory. How you are valuing your inventory, how you are taking care of slow moving and non-moving inventory being fully provided for. And in case if certain inventory are going for an expiration date, shelf life or whatever the case may be, how you are getting it reimbursed by the supplier. So when we are trying to do this assessment, what we are saying is that valuation of the inventory. Valuation itself is an assertion. Second thing is the inventory should be my own inventory. For example, if the non-corporate entity is doing a manufacturing activity as well as it is doing a job work, the contractor who has given the material to me for doing a subcontract on that and supplying back to them, I only add the labor charges on that. Material is owned by them, but the material is lying in my own factory or my own premises during the year end, whether it's my inventory. So how I am segregating the ownership with respect to that, or when I can say that what is my rights and what is my obligation associated with that particular inventory, that is also an assertion. And how I have presented that in the financial statement, presentation and disclosure is also an assertion, right? All these things are what we are looking for. Assertion level, what may go wrong? For example, valuation of inventory may go wrong because I'm not able to identify what is the aging of this, what is slow moving, what is non-moving, where the customer taste has changed. Is there any expired stock? I don't have that type of robust controls to ascertain all those things, robust employees to do that activity. In that case, there is a risk, and I am trying to find out what is the risk at that valuation alone. So I will focus more on the valuation relating to inventory compared to the other items, because the inventory was the key business driver for that particular non-corporate entity, and the risk associated with the risk of material misstatement is more on that particular area. Based on this mapping, I will decide what is the nature of the audit procedure I have to do. If I believe that the way in which the evaluation has been prepared and shared by the client, I will simply reperform that particular calculation and conclude whether the validation is correct or valuation is correct or not. If the client has a system of identifying the slow moving and non-moving, I will only check how they are doing it, how they are effectively doing it. If I believe that they are not having such a type of control, I will look at the detailed aging and the particular items and extend that. So nature, and what is the time at which I have to do this particular procedure. Normally, for a non-corporate entities, we can do all these things at the year end, because there is no requirement to make a quarterly financial statement or half-yearly financial statement. At the year end, we can do. But sometimes they may also prepare an interim financial report. This IFRS interim financial report. For example, they are going for a bank loan, and the bank has asked, we need last year audited financial statement, and we also want the financial statement up to 30th September audited. So they may prepare this also. And in that particular scenario, maybe for the September also have to do it, because it is required or it's becoming mandatory for a particular situation, right? And what type of extent at which I have to use my audit procedure. As I have mentioned that I can go for a simple ratio analysis, simple analytical review, or I can go for a very detailed inspection of the records, validate the records, looking at the agreements, etc., etc. But it all depends upon what is my risk, what is the key risk, and how the key risk will relate to my risk of material misstatement. When I have linked it to the particular assertion level, whether still I have to do it in a very detailed manner. So this is a simple trick. Once you have done, it's only execution and completion. But whatever I have talked about is very closely connected with the standards on auditing. Nothing I'm talking on my personal experience or so. It is only based on the standards on auditing. Apart from this execution and completion, what one may require to protect yourself is your documentation. So whatever you have done, for example, how you have determined what is the top down risk involved in that, how you have determined what is the key business driver in relating to that particular company, how you have identified there is no risk of material misstatement in that particular item. When you have identified there could be a possible risk of material misstatement, how you have assessed that risk and linked it to the assertion level, and how you have determined that this particular nature or this particular timing or this particular extent of my audit procedure is enough, and based on which what is the conclusion you have drawn and how you have reported on that document from planning, execution to your closing. That's all about the normal audit to be done for a non-corporate entity. There are some special consideration in any audit which you have to look at. And here also I am trying to look at what are all the special consideration which we have to focus in respect of a non-corporate entities audit. For example, when I'm saying a non-corporate entity, first and foremost, in my view, is that you should understand why this audit is being performed. Why we are asking this question? Because there is no specific law or regulation which mandates audit of a non-corporate entity. Depending upon the situation, depending upon the laws and regulations, where it may require an audited financial statement, audit is required. So what is the objective of an audit? Is it tax audit? Is it for raising a fund? Is it for submission to your investors? Is it for the purposes of valuation of your business when admission of a partner is happening, or when a partner is leaving, or you are trying to determine what is the profit which has to be given to the retiring partner, etc., etc.? You have to first understand what is the objective for which an audit of a non-corporate entity is required. Based on the specific objective, you have to look at what is the requirement which has been made it or maybe required based on your letter of engagement with the particular client scenario, right? So I have also seen that even though I'm talking about raising funds, retirement of a partner, admission of a partner, business valuation, etc., etc., majority of the cases when we are doing an audit, the audit is always relating to taxation considerations for non-corporate entities. Maybe for tax audit, maybe to get a particular claim, or maybe for the purposes of getting an exemption from taxation. In all these scenarios, or maybe even presumptive taxation, you may require an audit to be performed on a particular non-corporate entity. So this, if you ask me, maybe 90% of the scenarios, it may be, 10% could be other requirements. Okay, this is generic. This may be specific to a particular scenario, right? Now, when we are looking at this type of objective and what type of taxation related consideration, we should also look at what is the economic development which is happening or accounting development which is happening. When I'm saying economic development, this is directly connected with understanding the client's business and determining what are all the key risks involved in that particular company. That is what is the relevance here, right? Accounting development means your presentation and disclosure should be in line with a particular style, or the policies which the company has adopted in respect of a corporate entity will be in as per the company's act provisions, section 133, etc. Where in non-corporate entities, what are all the standards which has been notified by the Institute of Chartered Accountants of India based on the levels up to which what type of exemptions in disclosure, presentation, etc. you will gain. All those things you have to keep yourself updated. Otherwise, there could be a wrong accounting policy selected, or maybe the disclosure requirement is not fully taken care. You remember that non-compliance of an accounting standard could also lead to qualification. You have complied with an accounting standard, but not made a specific disclosure required to understand the accounting treatment, or maybe it is critical for understanding the financial statement. In that case also, SA 705 says you have to evaluate whether qualification is required, whether it is pervasive on the financial statement. So the accounting development also we have to look at for the non-corporate entity. More specifically, I would suggest that a key risk will always be associated with the related party transaction. Since I'm a partner, or maybe 2-3 friends have joined together and formed a business, they will try to accommodate their next generation, their relatives, etc., in the business or in the associated activities. For example, if I am in the manufacturing and assembling, and somebody in my related relation can do a particular subcontracting work and give it to me, or I may be employing my own relatives in key functions of the particular non-corporate entities, all those things could be possible. The moment there is a related party transactions is there, we should also look at how we are validating the related party transaction, because it normally becomes a one way of looking at that. In a bigger companies, related party transaction is always considered as a fraud risk area. When it comes to a closely held or a non-corporate entities, it may not be a fraud risk area, but it may be specifically reviewed or specifically focused by the tax authorities. When I say tax authorities, 48(2)(b) is one of the section, right? That section is talking about whether the payments made to related parties are excessive than the market price, and the assessing officer has a right to disallow that excessive amount and add it to the taxable income. And the client has to run around to prove that it's not excessive than the market price in the appeals and other related litigations. So giving them making a focus towards the related party transaction and helping the client to ensure that they are not getting into some sort of litigation at a later point of time should also be a special consideration in an audit of a non-corporate entity. And this professional skepticism goes as a requirement, or it should be in the DNA of a chartered accountant, right? So whenever something is coming in, or we are looking on the abstract, or we are looking at the obvious, is what we are expected to be performed according to the standards and auditing. If we are saying that we have our own questioning mind and asking whether something is relevant to this particular transaction has been properly taken care, and on that basis my conclusion is also reached, this professional skepticism, talking about a questioning mind, and if you are not able to question your client, or you are not allowing the client to question you, you cannot do a better service to a non-corporate entity. And of course, fraud risk and management override is a possible area of issue for a non-corporate entity, because management overrides every control. If you say that there should be a maker checker, they will say, I don't have time, I will go ahead with that. When you are saying that when you are two partners are there for any payment more than a particular level, both the partners need to sign, but one partner is not available, or one partner is at a hurry to complete a particular transaction, they may override whatever controls which we are talking about in a particular level, right? So this management override is resulting in a mistake, or the management override resulting in a fraud, and that fraud makes the financial statement totally having risk of material misstatement. We normally look at one aspect. whether there is a fraud risk. What are all the areas susceptible to fraud risk? Have we taken care of that fraud risk as part of our audit procedure? This is the normal thing which you are supposed to do. And of course, there is a complete guidance available by SA 240, which says that how the fraud risk has to be considered in planning an audit of any entity. Then, the laws and regulations impacting the client's business. It is directly connected to the objective. What are all the laws and regulations? If non-compliance with the laws and regulations can even result in this completely closure of the particular business. For example, an entity is supposed to take care of the pollution control regulations, and that controls or the proper renewal has not been done, proper maintenance is not being done, and the company, that entity may get completely closed down, right? We have seen a lot of dyeing unit or leather units have similar fate in southern part of the country as well as in northeast part of the country. We had this type of issues relating to laws and regulations. So we should necessarily look at that particular item. For example, if you are auditing a company, auditing an entity which is a NGO and it is getting foreign contributions, how the Foreign Contributions Regulation Act has been complied with, because the penalty involved in that is so significant. And what is the related, FEMA related violations could have an impact. So all these things is what you have to specially focus upon. The ultimate thing is you have to get sufficient, appropriate audit evidence for reaching your conclusion. But I believe that it is not a big deal. As long as you carry on this special focus and key business driver assessment, etc., I think that it is very simple. And one area where the auditors of non-corporate entities are questioned is relating to external confirmation. Especially there is a loan taken or maybe some sort of bank transactions are involved. What type of confirmation which you are getting? Normally, we get a confirmation of a bank statement. Maybe the client might be having a bank statement, and we will simply see whether the closing balance matches with the financial statement, or if it is not matching, whether there is a bank reconciliation statement, whether the items in the reconciling statement, bank reconciliation statement has been subsequently cleared or not. But sometimes we are taking it very lightly. If you believe the client's business is a little complex and you have a worry that there could be a possible management override of control, or maybe some employees can actually have a fraud on the company, in those scenarios, external confirmation will be of good help. In fact, I have seen that not only external confirmation relating to banks, key customer of a particular non-corporate entity, key supplier of a particular non-corporate entity. Normally, if you are looking into that particular cycle, sales and related trade receivable cycle, purchases, inventory and payable cycle. If these two cycles, when you are looking at, the number of suppliers or number of customers were very, very, very minimal for a non-corporate entity. If you are concentrating on the key customer or key supplier and their statement of account has been identified, matched, and the external confirmation is also received, you are reducing your risk of material misstatement to the lowest possible level. So that is the reason why the external confirmation plays a crucial role. And of course, you are supposed to look at subsequent events as well. The subsequent event, to my mind, normally looks at two aspects for NCA, non-corporate entity. I will actually write here. One area which I'm talking about is the NRV testing for your inventory. This is what subsequent event will help. Continuous fall in the prices of your product can show that your net realizable value of inventory will be lower than that. So for that, if you believe that the risk relating to inventory is much higher, preferably you can think about doing. this particular subsequent and must. Second is when you are worried about whether going concern is affected. Majority of the cases, what we have seen is non-corporate entities, because of difference of opinion between the partners, or maybe because there is no succession plan which is being incorporated, they may have the plans of winding up the entire operation or reducing the level of operation dramatically. So in that case, going concern could be a possible issue. How you will identify the going concern issue? By looking at the subsequent event after 31st March to the date of signing your audit report. So you can evaluate whether anything will be having an impact. This is another way of doing things. This is the second area which I have seen. Whether any other area subsequent event could be a situation, I can talk about one more area where litigations are there. For example, you got a demand, you got a search which has been happened in a particular client's in a situation. Very huge tax demand has been asked for. Client has voluntarily admitted certain income, etc. In those scenarios, what is subsequent event may have a relevance for doing this. So the practical approach which we have talked about in the previous two slides and the special consideration can actually help you in completing your attest function in a bigger manner. What may be the key requirements here, or why audit may be required? We have already discussed this. Audit of financial statement for submission of banks, financial institution, or for raising funds, audit under the Income Tax Act, and there could be a possibility of compliance with the income computation and disclosure standard again for taxation purposes. Maybe any other tax work which requires an attest function. And apart from that, we have also seen the other scenarios where there could be valuation related issues, etc., or dependent on the audited financial statement. Some of the standards I am trying to focus for our discussion. You will laugh when I am saying agreeing the terms of audit engagement SA 210, you should have a letter of engagement with your non-corporate entity. Friends, please understand that more than a corporate entity, non-corporate entity letter of engagements are more important because succession plans may not work. Litigation between the partners may first link the auditor into that particular litigation also. So accordingly, agreeing the terms of engagement is a better way of looking at that. I talked about identify what is the laws and regulations relating to your business, the non-corporate entity. Coming from SA 250, detailed guidance is available. All the guidance is fully available for you in respect of this particular situation. How you wanted to plan your audit? Maybe even for 100 hours, reducing from 300 hours to 100 hours, definitely I should have a proper planning, right? So this can be achieved only if you are having a proper planning. How you are trying to do your planning activity? SA 300 gives you a guidance. I have talked about materiality, which is normally ignored in respect of audit of a non-corporate entity, but it may make it completely effective audit and help you in doing this particular achievement for planning and for performing an audit. SA 320. Okay, I mentioned about 320. Yes, it is 320 is correct. Now, this is what I have talked about. Analytical review, identifying the areas where you wanted to focus. Nothing great. Just to take the balance sheet as prepared by the client or from the tally output which they are giving and compare that with the previous year, identify the areas where there could be significant deviations and what is the reason for the deviation, whether it requires a special audit procedure. SA 520 will help you. And collecting an audit evidence, you have a lot of procedure. You can inspect, you can question the client, you can verify the document, you can validate the document, ledger review, sampling techniques, all those things you can do by SA 500. External confirmation, I have already explained that why it is required. SA 505 gives the guidance how the external confirmation has to be taken care. The analytical procedure is not only talking about preliminary analytics, it also talks about final analytics. final analytics and the analytical procedure can be also for doing your audit procedure. Like I talked about rent. In fact, in one of the publication company, it's not a company. Again, we are more focused on companies. So I'm repeatedly using the word company. Sorry for that. Even for a partnership firm which was engaged in publishing activity, they have just done an analytical procedure by which the revenue cycle has been fully validated. I might have taken a sample because the weekly billing which they are talking about for individual dealers is hardly 3,000 rupees per invoice, but their turnover is somewhere around 100 crore. 100 crore comprising of 3,000 rupees of invoice for each of the customer at various cycles. How I can validate, even if I am taking 1,000 samples, I will not be able to get a proper comfort, right? So what we have simply done is what type of publications they are doing, weekly, fortnightly, monthly, and what is the cost of their doing this when they are selling it to the dealer, and what is the expected dealer price and discounts. All those things we have netted off and multiplied by that by the number of units sold. Number of units sold we have not taken from the books of accounts. If I have taken from the books of accounts, it is not an independent expectation. Being a publishing house, they publish with the Press Bureau of Information. It is like a GST return. They are also filing a monthly return there, which determines which is number one magazine or number one newspaper, etc., by means of circulation, etc. So this is an independent information available. We took that particular independent number with respect to monthly, weekly, fortnightly, etc., multiplied by the cost at selling price at which it is sold to the dealer, and we have taken that number and we have fixed 5% as the deviation from the expectation, and then looked at what is the number accounted in the books of accounts. More or less same. Hardly it was having 7% deviation, not 5% deviation. Since 7% deviation is not acceptable, I have only fixed 5% deviation. We identified what is the reason for that 7% deviation. In one particular scenario, what has happened was they have come out with an annual edition also, which we have not factored. For the annual edition, they have charged very huge money. To that extent, the revenue has gone up. In another scenario, one of the magazine has been fully stopped during the current period, but we have taken that number only from the circulation list. And in the process, the averaging which we have taken is not correct. And one particular issue, they have given free of cost, but we have taken the number and what is the dealer price at an average based on a normal selling price. So this particular issue which has been given free of cost is not considered. So this, when I have adjusted, gave me the comfort that what I have expected, and with the adjustment for the deviation, I got the number which is required to be fairly presented as sales. So that is a very, very comfortable way of doing an audit of a non-corporate entity. Majority of the cases, analytical procedure can be done and done. Even for depreciation reperformance, if you see the analytical procedure, it says that you can see the opening plus closing divided by 2 is an average, and on which what is the average rate of depreciation, that will give you the depreciation expectation, and then check with the books of accounts or the financial statement. If it is acceptable, then move on that. Within the deviation level, you can move further on that. It is again as per the standards on auditing. In cases where you believe that you have to necessarily go for audit sampling, SA 530 gives a complete guidance. You can go for a scientific method of sample taking, or my take for a non-corporate entity, you can actually go for what we call as targeted sampling, targeted testing or targeted sampling. What is targeted testing? Anything more than 1 lakh rupees I wanted to target and audit. In a non-corporate entity, anything more than 1 lakh could be an exceptional item, right? I will focus on that. I will target all the year-end sales to check whether the sales has been accounted in the respective period or it should be considered as a delivery made subsequent to that particular period. Like this, I can target. Suppose, for example, if there is a possibility of I'm doing a tax audit, I have to concentrate on whether TDS has been properly detected and remitted in accordance with the various provisions of Section 194. Then what I will normally look at is that what are all the account balances which will have the implications on that. I will target on them and then do my own activity on that. Right? So this type of thing will give you more guidance. Even when we are talking about traditional way of doing an audit of a non-corporate entity, what we have seen, even when there is a manual book at that point of time, even when we are doing an audit based on the tally software which we are having, we are arranging the transactions higher amount to lower amount. We are trying to target the top 10 items, which are constituting 70 to 80% of the account balance. And if that is correct, we are believing that others are okay. That is what is a better way of doing an audit sampling when we are talking about a non-corporate entity. Estimates, in my view, the estimates for non-corporate entities can be only one or maybe two. If we are looking more, it can be three. One is gratuity. One is gratuity. Second is your estimate could be for bad debts or doubtful debts. And the third one, which I'm saying, could be non-moving, slow-moving inventory. Only in these areas, the estimate could be possible for non-corporate entities. In case if it is a manufacturing entity, we can even add warranty as an additional. In all other cases, we are driven by a simple process. Even I'm talking about taxes based on whether it's a partnership, straight away, whatever income as computed by the taxation laws, on that you are going to pay 30% or whatever percentage, right? With the surcharge, education, etc. So the accounting estimate, only these four areas you have to concentrate. We have already discussed this and this. Warranty, you know pretty well. What is a claim which is being made by the buyers over a period of time? And you see that that percentage is actually looked at maybe 1% or 2% or maybe 0.5% of the total sales. Make a provision on that. It's a scientific method of making a provision, so allowable under the taxation laws as well. Gratuity, nothing to worry too much, because in non-corporate entities, the accounting standard as prescribed by the institute is applicable. It says if the number of employees is less than 50 employees, employees are less than 50. In that particular situation, it says you can even do an actual liability basis provision for gratuity. If the client says that the cost of getting actuarial valuation is not affordable and the number of employees is less than 50, you can still get you can even make a provision based on actual liability basis. As far as the client is concerned, it doesn't make any difference, because for them, bottom line and top lines are not priority. Their priority could be cost effectiveness, at the same time compliance with the taxation laws, right? So this is an estimate. Related party transaction, we have already discussed. I said that the standard can give a lot of guidance, 550. Subsequent events we have already discussed. It can also give a lot of guidance. And use of experts. To my mind, you use the expert only for gratuity and leave encashment provisions, and nothing more than that. And to that extent, actuarial report is the only thing which you will be doing it. So if it is a registered actuary, nothing to worry about non-compliance with the SA 620. Only the base data which has been given, the actuarial assumption has to be validated. There is a matter on that particular item. Also, try to get a letter of representation from the client after the completion of the engagement. And this is one thing which I see. Communication with those charged with governance is a word. It looks as a very big environment. But a partner or a proprietor of a non-corporate entity would like to discuss with the auditor after the end of each audit engagement. you may aware that whenever the search is happening on the client's situation, especially for non-corporate entities, they normally say, I don't know anything, everything is known only to my auditor. In the process, the auditor is becoming an accomplished, is party to that particular concealment of income if it is happens to be, right? So my suggestion or my way of looking at this communication is client should know what is there in their financial statement. Client should know what is there in their particular income tax return and how their business is functioning. What are all the possibilities of expanding the business? What are all the areas where you believe that the cost can be saved? What are all the tax planning options available, but the client has not done it because of that? What are all the procedures which the client has followed, which resulted in certain disallowances? For example, cash payments, etc., has resulted in a bigger disallowance. So if you are communicating to the client, it is in fact, it is though it's called a communication. I believe that for a non-corporate entity, it is an awareness project, or it may be a session where you are educating the particular client to understand his own financial statement. So I believe that it's very important to do that. So SA 520 again talks about final analytics, which you can help to see that there is no mistakes which has happened in the financial statement, which is you are going to sign. Finally comes your audit report, 700, 705, 706. I will spend 1 or 2 minutes on this particular item. Auditors of non-corporate entities are thinking that SA 700, 705, and 706 is not applicable to non-corporate entities. They believe that it is applicable only for a company. First, change that view. Because SA 700, 705, and 706, if you see the title itself, it talks about independent auditors report. It may be for a corporate entity, it may be for a non-corporate entity. You have to follow the entire process of SA 700, 705, and 706. What could be the difference between a corporate entity and a non-corporate entity when it comes to SA 700, 705, or 706 is that in respect of a corporate entities, the audit report is split into two sections. Audit of financial statement, audit of other laws and regulatory sections. So there are two sections for a corporate entity because under the Companies Act 2013, you have a responsibility to report for CARO. You have the responsibility to report under internal financial control. You have the responsibility to report under section 143, subsection 3. And you also have a rule 11 under the Companies Auditors Audit and Auditors Rules 2014. Even now, there is a small amendment which has happened in the current period. So these are all the regulatory and legal requirement. When it comes to non-corporate entity, they are not falling under any particular legal framework. This is an audit done for a particular situation, right? And accordingly, only the first part of the audit report is applicable. But if you see the first part of the audit report, it has identification of financial statement, or otherwise I could start with opinion, basis for opinion, emphasis of matter, and you have other matters paragraph, management responsibility, auditor's responsibility. With that concludes, right? So in whatever is the format which you are using for a corporate entity, on that the first part is squarely applicable to even a non-corporate entity. And in case of qualification, you have to go to 705. In case if you wanted to add other matters paragraph or emphasis of matter paragraph, you have to go to 706. So this is finally the output goes to the client from your side. This 700 may be for audit of financial statement or a tax audit form 3CB, 3CB, or any other thing. Even when we are talking about specific audit report given for minimum alternate tax under section 115 JB in form number JB in form number 29B. So anything which we are talking about, you should always ensure that the minimum requirement of SA 700 has been properly taken care, right? So that is exactly. Some of the forms have been prescribed by the law. So the guidance says that to that extent possible, include the matters which are required by SA 700, 705 and 706. So reporting and audit opinion, you should always look at this particular standard as well. Some of the audit procedure which you are performing to obtain audit evidence in the case of a non-corporate entity could be risk assessment procedure, which we have already discussed, and any other procedure which you are going to do. Risk assessment is to identify the key risk, key business driver, fraud risk, etc., etc. For example, the other procedure which we are talking about, you can test the controls if the control environment is good. But what we have seen is 90% of the cases, test of control cannot be performed because there is no robust internal control system existing. So you will only go for substantive procedure. That means test of details, test of transactions, test of account balances, test of the ledgers, etc. You will do the substantive analytical procedure. So when we are talking about this scenario, there could be, this is actually not connected to this. It should be actually connected with this. This is a wrong place where that is actually coming in. Test of transaction, you can do vouching, you can review transactions, etc., etc. Test of balances is closing balance is verified. It is reconciled with the external confirmation. Any adjustment required is being passed. All those things, and whether the balances has been properly valued, any adjustment required to write down the value, etc. You do that as part of the substantive procedure using the various focus auditing standards which we have talked about. So, for example, if you are talking about sales, I have taken some 2-3 components for the purposes of our discussion. One is sales. I have talked about sales and receivable as a process. What would be the worry which we will have whether year-end sales are relating to current period or for the next period? How you will verify? Take last few transactions of the current period and see what are all the delivery challans or gate pass or whatever evidencing that the third party has also confirmed that the risk and rewards of ownership has been passed on to the buyer. Take that as the sales for the current period. If it has happened subsequent to that year end, it is not the sales of the current period, it should be reversed, right? Similarly, sometimes there could be a possibility because the accounting personnel may not be very strong enough. Some of the shipment which might have been happened is recorded only where the customer has accepted that particular shipment, or maybe some items might have been transferred to the customer and the customer has not yet completed its verification of quality. Because of that, they will say, sir, customer may reject and accordingly we will wait. So you have to validate the subsequent periods invoices also to check whether it's relating to the previous period. I've seen cases where a small partnership firm which was manufacturing auto and automobile auto ancillary components has a clause in the purchase with the OEM customer where they have said that if the steel prices are going up beyond 10% compared to the previous period, there is an adjustment in the price. Okay. But the steel prices have gone nearly by 30-40% in one of the year. And when they were supposed to raise the bill, they have raised the bill at the old prices because they have not got the revision in the prices. The revision in the prices has happened in the subsequent year. But as per the contract, they are entitled for it. But official communication came only in the subsequent period. The entire supplemental invoice has been accounted in the subsequent period, which is incorrect, right? It should be the income because all your cost has been absorbed in the current period, whereas sales is being accounted in the subsequent period. So cutoff procedure is one area which you have to look at. Receivables aging analysis will always help you to identify whether any provision for bad and doubtful debts is required. when you are looking at the aging analysis, if you are seeing that old invoices are not paid, but subsequent invoices are fully paid, there could be a possibility of litigation or difference of views between the supplies. Defective supply might have been made in the previous scenario where the entire sales is to be reversed. So that also gives an indication. I have raised an invoice for 1.5 lakhs or maybe another invoice for 75,000 rupees. The customer pays only, say, 80% of the invoice, 20% he is not paying. The 20% is it a retention according to the sales order? If it is not retention, is there any reason where it is a quality cut? You see that? And customer is not making full payment, he is making only on account payment. And how the company, the entity is actually adjusting the number. All these things could actually help you in understanding whether any provision or the valuation of trade receivables are correct or not. Just do that activity as well. You can do analytical procedure, as I have mentioned. You can do the ratio analysis. For example, when I am talking about the ratio analysis, how many days the debtors are outstanding in the current period and how many days it is outstanding in the previous period. If there is a significant deviation, why? Who are all the major customers where this particular variation is being observed is the next way of looking at that. Sales discount and sales returns. What is the policy of giving discounts? Whether the discounts have been properly accounted for. If it is a volume discount, what is the threshold limit on which the customer can be entitled for it? For example, after you if you have lifted 1 lakh units, 1 lakh components in a particular year, you will be entitled for 10% discount if it is the sales agreement. We have to see right from the first component which has been sold, they are entitled for 10%, or only over and above 1 lakh units, they are entitled for that. That is also another thing which you have to look at, how this volume discount, trade discounts, cash discounts, etc. are working. If the company has a track record of billing, I have seen this particular situation. We were auditing a small cooperative society. In that cooperative society, what we have actually seen is that they are selling certain food products. Month on month, they are booking the sales. Month end, the sales are booked. And after 3 months, there is a huge returns. Maybe because shelf life is gone, or maybe for some other reason, a defective material, it is actually getting returned. This has not happened once. If it is happening only one time, we normally say one-off event. If it has happened the second time, the auditor's professional skepticism will be on the higher level, and he will ask whether it is a trend. If it is a trend, I always try to find out what is the return policy. If the customer happens to return at least 10% of the total sales in a particular year, we are thinking, or we are estimating that this year also we are expecting minimum 10% of the sales being returned. And there is a guidance which was issued by the institute where they have said, it's part of an EAC opinion, where the institute said, in such a type of assessment, there should be a provision made for sales returns. Either you can reverse the entire expected 10% of the figure from the sales, or what is the margin relating to that which you will not be able to make out because of the return happening in the subsequent period. So you are making a provision only towards the margin. There is an expert advisory committee view which suggests you that you have to follow that particular method of accounting. So look at that particular area also. And then you can think about sampling, as I have mentioned. Cutoff procedure means year-end targeted testing. More than 1 lakh rupees invoices I will validate, or every month I will take the last few transactions and first few transactions. Like that, you can, based on your experience, decide what type of sampling procedure which you can do. If the control environment is good, you can do the control testing, and based on which you can reduce your substantive testing. If the control environment is not enough, you'll go for test of details. And of course, with the parties, definitely you will look for external confirmations for the trade receivable, at least for major parties, because it's a um, non-corporate entity, I believe that few customers only will be there. If you are getting a statement of account and getting the confirmation, that helps you to identify whether the trade receivables are genuine, whether the trade receivables are capable of being realized, and whether you can rely on the customer's confirmation of balances. Sales also prove to be genuine. And of course, when we are talking about external confirmation, you will also look at what is the subsequent realization of the debtors. A particular customer never paid, even after 3-4 months, or maybe when we are doing the audit, it may be even October for tax purposes, or September or October, or transfer pricing involved means we will even do it November. When we do that, the particular data which has been billed in April of the previous year is not yet collected, means there is a worry which we are having. So that is also how you can look at that. Second major component in a case of a non-corporate entity I have seen as property, plant and equipment, especially manufacturing units, etc. So what is the acquisition? What is the major disposal during the period, whether it has been properly accounted for? All the related costs like transportation, consultancy, etc., has been accounted for. You can do the audit of that. More importantly, what is the title deeds? Because this is one issue which we have seen in majority of the non-corporate entities. The property is acquired in the name of the partner or the proprietor's wife, but recorded as the property of the non-corporate entity because they have used the funds of that. The biggest worry which we will have is it the business asset or it is the personal asset of this? Instead of giving a loan, they have just recorded that as an asset here, and whether the ownership is really correct according to law for the particular non-corporate entity, or it should be treated as a property of the particular person in whose name it is standing. So the title deeds verification is important aspect for them. Identifying what is capital, what is revenue is always a point of debate. You will also realize that whether this particular item is capital or revenue, etc., and do that. And what is the depreciation policy? Here, maybe I can suggest one practice. I felt that it is a good practice because what they have done is it's a small non-corporate entity. It's a partnership firm. In a partnership firm, you know that even if I am providing any depreciation based on useful life of the asset, that will be disallowed and you will get only IT depreciation, right? And this IT depreciation, whether it is in WDV normally, right? In WDV method, on a block of asset basis, when you are having this method, it is also forms part of that 15% or 20% or 25%, whatever they are giving. They have also estimated that this could be the normal estimated useful life of a particular asset in the business, right? And accordingly, in one non-corporate entity's financial statement, the accounting policy relating to depreciation said that depreciation is provided based on the rates prescribed under Section 32 of the Income Tax Act 1961. In the view of the management, the depreciation charged under the above act considered to be relevant, reliable, and proper representation of the useful life of the asset. They have considered that what is prescribed is equivalent to my useful life. So nothing great which I have to evaluate. And if at all you are going to qualify, who is going to worry about your qualification in the audit report that you are not following the useful life? So they have followed that. Practically, you can think about using that also, right? But only thing is there is a accounting policy where you are saying it is the relevant and reliable presentation, and it is considered to be the estimate of economic useful life. So you can make use of that option also. Impairment testing, to my mind, very, very rare in the case of a non-corporate entity, unless they are into a technology field. Otherwise, I believe that it's very minimal. And one case, maybe we can add it is, suppose if the non-corporate entity is manufacturing products using molds, dies, etc. And the molds and dies can, maybe the model is outdated, etc. And the molds and dies will be completely useless. So whether that impairment testing could be another scenario. If I am going beyond that normal situation, could be another area of impairment testing. Other than that, I do not know, do not think that any other areas will be part of it. And of course, physical verification, not mandatory, because you are not giving any report whether the company, the entity has carried out any physical verification. There is no legal requirement. But at the same time, the existence of the physical verification, the existence is also one of the assertion level objective which we are looking for. Really, there is a fixed asset which is existing. If it is not existing, then the asset should be fully written off from the books of accounts. Have you done the physical verification? That is one reason. The second is the control over the physical verification of the fixed assets will help the client to ensure that their interest is also protected. They are not losing any of the fixed assets. So periodically, let them do the physical verification also. Tell them at least once in a year, you try to carry out. If the volume is high, maybe over a period of 3 years, cover 100% of the total asset to ensure that you are not losing any of the asset. So that is one area where you can ask them to focus on. The third component which I have seen is basically inventory. Maybe a retail business or manufacturing unit, or maybe a trading activity, wholesale business, etc. Inventory is one of the major component, and there are specific risks associated with them. So in the purchase, there could be a possibility. And if it is a manufacturing unit, allocation of variable overhead, allocation of fixed overhead, etc. How that has been audited is the next worry which we have. Whether the valuation of inventory has been properly done, and whether that has been at the lower of cost or net realizable value. Have you done that validation as part of the audit is the next thing which you require. And this is something interesting. Retail method of inventory valuation. I have seen that this retail method is permitted method of valuation even under ICDS, income computation and disclosure method, in disclosure standards. What is retail method? You can take the selling price, retail selling price, reduce margin. Say, for example, my margin is 20%. I will value the entire inventory at 80% of the selling price. Right? So, this is also a possibility in which you can simplify the activity in case if the client is in the retail business. But only thing which I normally look at is this margin when you are talking about 20% is nothing but your gross margin, right? GP percentage or gross margin. And this gross margin, you are also giving as part of your tax audit report. In the last, but one, if I'm not wrong, last but one clause, you are giving accounting ratios. In the accounting ratios, current year ratio as well as the previous year ratio, you are giving along with the calculation. If that gross profit margin is, say, for example, 5%, right? You are reducing 20% from the selling price. What happens? Your inventory is valued lower by 15%, correct? Margin is only 5%. That means I should have taken selling price minus 5%, 95% I should have done it. If I am just following 20%, which has happened in the previous years, without looking at what has happened in the current period, then the assessing officer may consider that 15% is lower estimate of the inventory and he can add up. So only risk which you are having in the retail method is by oversight, we may commit an error. But if your audit procedure calculates this retail price, validates the retail price, and also check what is the actual margin in the current period and previous period, whether this is consistent with the application done, that is also one area where you can get a comfort. Physical application, again, to prove the existence and also no loss of asset, you will insist on this. One thing which I have seen as a problem with non-corporate entities is that they, without knowing the implication, they give a stock statement to the bankers. I still remember that one client has given a stock statement on 31/3 to the bank. And when we were doing the audit of the particular non-corporate entity, we asked for the stock statement submitted to the banker. And when we have received the stock statement, we saw that what is the stock considered in arriving at the profit for the year is lower by more than 50% of the stock declared for the bankers. So we asked and evaluated what are all the reasons behind that. In the particular client scenario, what has happened was quantity is correct in both the list, what is given to the bank and what is being used here. But the rate adopted is selling price for bank and cost or NRV for book purposes. Because of that, it has happened. So when we have carried out this particular assessment, we felt that, okay, there is nothing to worry. But if the quantity is also wrong and the rate which they have considered as may also be wrong, we will consider that. Now, you have to be careful on one particular aspect. As per the new, or maybe I can say it's not new, recent judgment in the Supreme Court, if there is a difference between the stock declared to the bank and stock considered in the financial statement, the assessing officer can add this difference as a concealment of income, and he can even go to the extent of levying that special tax rate for concealment of income, 60% plus penalty, etc. That is a recent judgment from the Supreme Court. So you have to be specifically careful. And interestingly, in one case, what we have seen is once we have asked for this statement and validated the information and updated the stock statement, the client was smart enough for the next year. When we asked the stock statement, he said, "Sir, I have not given any stock statement to the bank as on 31st March. The audit team is also smart, right? The audit team has simply asked their next question in the order of their relevancy. What is the last stock statement you have given to the bank? He said, I have given on 30th of March. He believes that only 31st March the bank statement or stock statement will be compared by the auditor and nothing to do with 30th March. When we were looking at 30th March stock statement and the subsequent quantity movement in the particular stock statement, we have again identified there is a variance and told the client that what is the risk which they are carrying for the taxation purposes, and then they have agreed for offering the correct stock figures for the tax purposes also. Sometimes client requires this type of lessening or teaching and counseling, and also making them to completely aware of their responsibilities as well. The next important component from the point of view of a non-corporate entity, which I have seen, is a cash and cash equivalent. Because it's bank balance, cash balance, how that is being confirmed as at the year end is the next point. So physical verification of cash balance, if huge cash is being maintained, bank reconciliation statement, and the external confirmation from the bankers for all bank accounts. It is not only current account. You have to go for a loan account, your CC account, your fixed deposit, your current account, and any other account. Maybe sometimes they will also keep recurring deposit because it's a non-corporate entity. Proprietor will be having a policy of putting a recurring deposit to an annual liability which he has to settle at a particular point of time. So when you are looking for the bank confirmations, you have to look for all the bank relationship. And I will even go to the extent of saying bills purchased and discounted and guarantees, bank guarantees. Because bank guarantees may be relating to a dispute or maybe relating to a performance guarantee. In that particular situation, whether any contingent liability has to be looked at, also you can look at. So these are all the areas where we believe that there could be a possibility of looking at very focusedly on a particular component and do the activity. And as I have started with that, to summarize, if we are understanding the objective for which an audit is being done for non-corporate entities, what is the laws and regulations relating to that non-corporate entity, what are all the risk of material misstatement, and what are all the key drivers which may contribute to the risk of material misstatement, knowing the limitations which are being there in the non-corporate entity because of number of employees, control may not be properly in place, etc. And if you are planning your audit and executing the audit in accordance with the standards on auditing, as we have discussed over the last 1.5 hours, I think that you will be able to do an effective and efficient audit. And if you start using this process, maybe your bottom line will also improve because your cost is getting reduced and you are able to complete your audit in a more effective manner. Your bottom line can also be increasing. So if there are any questions, I will take those questions. And anyway, my contact details is also there. Mr. Anil, you can.
Thank you, sir. Thank you, sir. Can you hear me?
Yeah, I'm able to hear.
Yeah, thank you, sir. Thank you so much for such a wonderful and detailed deliberation. And it was really nice to have you here. And I have gained a lot through your deliberation. Sir, I have received certain questions.
Yes, sir.
Sir, first question is, do audit of LLP required under Income Tax Act or Companies Act if it has turnover of above 1 crore and less than 2 crore? Okay. And it has no cash assets and payments.
Okay. So previously, when we were talking about LLP, we considered that LLP as a non-corporate entity. That was the normal conclusion which we had up to the last year. But the guidance which has been issued very recently by the Institute of Chartered Accountants of India, LLP is considered as a corporate sector, but not falling under a normal Companies Act procedure. It is coming under a special statute and special provisions of the Companies Act, and accordingly, they have even published what should be the illustrative format for LLP. And I will say that it's not a non-corporate entity. It will be having a specific requirement under the LLP Act and also certain procedures which are applicable to file the returns with the Register of Companies as an LLP should also be followed.
Yes, sir. So one question is relating to the due date of filing of return in case tax audit report is filed under clause 4484 and profit is less than 8%.
Okay. Even though it is not relating to our
yes, sir.
Discussion, it is relating to tax audit. I think that to my knowledge, the moment you are talking about it's a tax audit, the due date applicable for a tax audit will be applicable. So the moment you are having less than that 8% thing, you are required to get your accounts compulsorily audited. So that is also a part of that particular provision. And accordingly, the due date of coming under the tax audit will be applicable is what my understanding. There is only one debate which is going on. Suppose if an entity is making losses, whether they have to compulsorily and they are not under presumptive taxation and accordingly they have to necessarily go to tax audit is one debate which was going on. Last year when we were analyzing this for a particular client's situation, we have concluded that yes, tax audit is also applicable to that and we have filed the tax audit report for that particular client.
Yes, sir. Sir, one question is relating to your expert opinion regarding the separate audit report as per SS 700, 705 and 706 or as per as the tax audit report also for the non-corporate entities.
Okay. So I will split this question into two parts. One, when I am doing an audit alone, not for tax audit purposes, for giving it to the bankers or something like that, that is one part. And another part is it is audited for the purposes of tax audit filing, Form 3CB. So if we are saying that it is only for the purposes of filing with the income tax department under 44AB,
yes, sir.
And I am giving the report under Form 3CEB, the guidance issued by the WASB when they have come out with the guidance note on tax audit, what they have mentioned was since the electronic Form 3CA and Form 3CB has to be filed electronically, you cannot amend the paragraphs. At the maximum, you can only put some remarks in that particular audit report, Form 3CA or Form 3CEB, Form 3CB. In both the scenario, we can only put some comments on that. So what we have started following is a simple process. We do an Form 3CA and 3CB in accordance with the requirement of SA 700. That's the guidance was actually saying, to that extent possible, align your audit report in accordance with the SA 700. We have aligned to have the paragraphs which are given in SA 700 and then taken a printout, hard copy printout, signed that, scanned it and uploaded along with the tax audit report. So, and in the remark column, we have mentioned that this Form 3CB to be read along with our signed copy of the audit report attached with this tax audit report. So in that process, we have taken care of making SA 700. On the other side of the story, for a non-corporate entities, what we have seen is also that people are believing that filing a normal e-form is enough. And I also accept their view for a smaller entity because it is not going to be reviewed by external reviewers except by the assessing officer. So if you are compiling, you are filling the forms and completing the audit opinion only in accordance with the electronic form also, it is nothing to worry about it. That is for tax audit. Suppose if this audit report is being given not for tax audit purposes, but for any other purposes, you don't have any choice. Your audit report should be exactly in line with the audit report on financial statement given SA 700. So you have to only see, is it for tax audit purpose? Then you can align your report in accordance with Form 3CB. To that extent, additional paragraphs can be added. If it is only for the purposes of any other purpose other than tax audit, you have to necessarily follow SA 700 format. Maybe I will do one thing, Anil. I have done one session for audit report for non-corporate entities. I will share that illustrative audit report which I have created. It is purely my view, not WSB's view. I am making the disclaimer. If anybody believes that that can be a better guidance for them when they are preparing this, you can use it as an illustrative, but not as an authoritative report. I will share that also, Anil ji.
Yes, yes. So there is one general question member is asking. There are so many laws and rules prevalent to bind the non-corporate entities. So how to identify what are the other laws or laws which are applicable for a particular organization other than the basic main law that are applicable?
It is not only for a non-corporate entity, even for a company case, we have the same scenario. How we will have a comprehensive list of all the laws and regulations which are applicable. But my practical approach towards this laws and regulation is first look at the standards on understanding the laws and regulations and the environment in which an entity is working according to the standards on auditing. It gives a application guidance how you can identify the various laws and regulations. This is point number one. More practical point which I have seen in my own practice when I am dealing with the non-corporate entities is that normally some 4 or 5 laws are more important. For example, if they are having employees beyond a level, provident fund, employee state insurance, gratuity, payment of gratuity, payment of bonus, minimum wages act, and these are all the acts which may have a direct impact on their financial statement. And you should also look at what are all the important laws and regulations they have to follow to continue in the business. And if they are not following that, whether any penalty will be levied. And the penalty will be significant for the financial statement. If you start narrowing down, you can eliminate, maybe if I am not wrong, more than 500 laws and regulations are applicable to any company or non-corporate entity. But you will end up with having hardly 10 to 12, which you have to concentrate. Because the idea is we are looking at the laws and regulations, the non-compliance of which will result in a material misstatement in the financial statement. If it is a small error or small amount is not provided for, we are not bothered because the audit opinion is also talking about material misstatement only. So on that basis, your guidance on the standards on auditing, and your practical experience of what are all the normal laws and regulations for this particular client, which may result in a material misstatement. Concentrate on that. That's the way in which I approach my clients.
Sir, for a small NGOs also, is audit report format applicable is the same as of the other big non-corporate?
SA 700 format is what you have to follow, sir.
For the small NGOs?
Yeah, for anybody.
Okay, sir. So last question, what special considerations for any political party is registered under Representation of People Act?
Okay. If my knowledge is, I have a very limited knowledge, but I one particular instance we have come across where they have formed one company within the group which will aggregate the donations, and then it is actually going to the political party contribution from that unit. They have formed that as an NGO only, not for profit organization. It's only for segregation. And there is a specific act which covers that. Similarly, for political parties also, if they are running their own financial statement being prepared, then normal audit procedure for a non-corporate entity will apply to them, because I don't think that they might have formed as a Section 8 company. So all the accounting standard, all the standards on auditing, all your audit procedures relating to that, all your laws and regulations, etc., as applicable to a non-corporate entity, you will apply for a institution which is on political parties as well, or contribution to the political parties in both the sides.
So thank you so much, sir, for.
Thank you, Anilji, and my sincere thanks to the entire staff members and the chairman and the vice chairman of the WASB for giving this excellent opportunity. In fact, after a very, very long years of gap, I am coming back to WASB to directly working on a particular conference, maybe through video conferencing. Maybe we will have more occasions to interact face to face. And thank you, Anilji, for making this to happen.
Thank you so much, sir. Thank you so much for wonderful deliberation and for sparing your valuable time, as well as acceding to our request on a very, very shorter notice. So on behalf of WASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time. Once again, thank you so much, sir. Thank you. More than 1,500 participants are still live. Wow. So thank you so much, sir.
I'm saying only 3 participants. That means only for this Zoom.
No. It is Zoom, but webcast through webcast. More than 1,500 participants are joined, sir.
Oh God! Thank you so much, boss.
Thank you, sir.
All the participants, thank you very much.
Thank you, sir. Thank you, sir.
Can I leave the?
Yes, sir. Yes, sir. Yes, sir.
Thank you. Bye.
Thank you, sir.